You just wrote your 156th rent check. Mike wrote his 156th mortgage check. You're both broke, except Mike's house just handed him a check for $170,000. Here's the math that'll make you sick. You're sitting in Starbucks with your college roommate, Sarah. It's 2010. You're both 25, just landed real jobs making decent money for the first time in your lives. She takes a sip of her latte and says, "I'm buying a house." You almost spit yours out. "Sarah, we're 25. Houses are for old people. We're supposed to be traveling, living downtown, having fun." She shrugs. "Yeah, but I'm tired of throwing money away on rent." You laugh. "Dude, you're not throwing money away. You're paying for flexibility. What if you want to move? What if you lose your job? You're going to be stuck." She buys anyway. A small 3-bedroom for $185,000 in Phoenix. You rent a sick downtown loft for $400 a month. Exposed brick, walking distance to bars. Life's good. Fast forward to last Tuesday. Same Starbucks, same Sarah. Except now you've paid $246,000 in rent over 14 years. That's not a typo. The Census Bureau tracks this stuff. Your rent checks alone could have bought a house. In cash. Sarah's house? Now worth $380,000 according to FHFA data. She's paid down $70,000 of her loan. Her wealth from that one decision? $265,000. You own really good stories about moving 6 times. Here's where it gets worse. Sarah's mortgage payment? Still $150, frozen in 2010. Your rent? Jumped from $1,400 to $2,100. Because landlords don't freeze anything. She looks at you and says, "I'm thinking of buying a second one." You look at your bank account. You're thinking about finding a roommate. At 39, that sick feeling in your stomach? That's compound interest working backwards. The Federal Reserve calls it the wealth gap. You're living in it. Same coffee, same friend, $265,000 different lives. That feeling you just felt? That's called the Paycheck Treadmill. And if you're in your 30s still, renting, you're on it right now. Running hard, paying every month, going absolutely nowhere. Today, we're breaking down the 40-year math of choosing rent over a mortgage. The numbers are going to make you angry. Some of you are going to get defensive. But by the end of this video, you'll understand exactly why homeowners have 40 times the net worth of renters, and what you can still do about it. Let's go. First, you need to understand, your parents played a different game. Your dad was 28 years old in 1990. Fresh out of college, maybe 5 years into his career. The median home price was $120,900. His salary was $28,960, the median income back then. That's a price-to-income ratio of 4.2 times. He needed about 4 years of salary to buy a house. The down payment? $24,580 for 20%. Here's the brutal truth. Even with 10% interest rates, yeah, rates were high back then, he could save that down payment in 2 to 3 years because homes were only 4x his income. He bought at 28, locked in that $800 mortgage payment. Done. Your older cousin was 28 in the year 2000. Same age, same hustle. The median home price was $169,000. Her salary was $42,148. That's a price-to-income ratio of 4.0 times. Still doable. Homes were actually more affordable relative to income than in 1990. Interest rates dropped. She bought at 28, just like your dad. The rent versus mortgage gap? Only $448 per month difference. Totally manageable. Now it's 2024. You're 28 years old. Same age they were. The median home price is $420,800 according to census data. Your salary is $59,384, the median income for under 35s. That's a price-to-income ratio of 7.1 times. You need 7 years of your entire salary to buy a house. Your dad saved for 2 to 3 years and bought at 28. You'd need to save for 7-8 years just for the down payment of $84,160, while paying $1,748 a month in rent that whole time. By the time you save $84,160, you're 36 years old, and rent has taken $124,000 from you. What changed? Home prices exploded faster than wages. From 1990 to 2024, homes went up 242%. Wages only went up 105%. The gap? 137% difference. Homes literally doubled in price relative to what you earn. That's not bad luck. That's structural. Rent stopped being the cheap option. In 1990, rent was $447. Mortgage was $800. That's a $353 difference. In 2024, rent is $1,748. Mortgage is $2,800. That's a $1,050 difference. In 1990, renting saved you enough to put toward a down payment. In 2024, renting costs so much you can't save for a down payment. That's the Paycheck treadmill. The timeline stretched too. Your parents' generation bought at 28. Your generation? According to NAR data, the median first-time buyer is now 38 years old. That's up from 35 just 3 years ago. Back in the 1980s? Late 20s. You lost 10 years of equity building. Those 10 years? Worth about $150,000 in home appreciation you'll never get back. The wealth gap became a wealth canyon. Federal Reserve data shows that in the 1990s, homeowner net worth was about 15 times higher than renters. In 2024, homeowner net worth is 40 times higher than renters. The gap didn't just grow, it tripled in 30 years. Your dad walked into a buyer's market. You walked into an auction where investors pay cash. So who's responsible for this? Is it your landlord? The banks? The government? Nah, the real villain is more subtle than that. Let me introduce you to the time tax collector. Picture a guy in a cheap suit, clipboard in hand. He shows up at your door on the first of every month. Month 1, you're 25. You just signed your first lease, $200 a month. The time tax collector knocks. Hey, just here to collect. You $200, please. You hand it over. He smiles. Great. See you next month. Oh, and by the way, this $200, it's gone forever. No equity, no ownership, just gone. But don't worry about it. You shrug. You needed a place to live. Year 5, rent is now $500 a month. The time tax collector shows up. Bigger smile. Good news. Your landlord raised the rent. That's $300 more per month. You've paid me $90,000 so far. Want to know what you own? You don't answer. Nothing. Meanwhile, your buddy Mike, who bought 5 years ago, his payment is still $1,100, locked in, forever, and his house went up $80,000 in value. But hey, you've got flexibility. You start feeling uneasy. Year 10, rent is $850 a month. The time tax collector shows up with a calculator. You've paid me about $180,000 over 10 years. If you'd bought a house for $200,000 10 years ago, it'd be worth $340,000 now. That's $140,000 in appreciation. Plus, you'd have paid down maybe $40,000 of your mortgage. He pauses. But you paid me $180,000 instead, and you have zero. So you're $360,000 behind Mike now. Your stomach drops. Year 25, you're 50. Rent is $3,200 a month. Quarter-century milestone. You've paid me $765,000 over 25 years. Mike, his house is worth $620,000, paid off. His rent is just property taxes, about $400 a month. You're paying $3,200 a month. And that number's going up. According to the Zebra, rent inflation runs about 40% higher than normal inflation. Mike's retirement plan? Live in his paid-off house. Your retirement plan? Keep paying me until you die. Who is the time tax collector really? He's not a person. He's a system made up of rent inflation climbing 3 to 5% every year while mortgage payments freeze. He's opportunity cost. Every dollar you give him could have bought equity. He's time. The longer you wait, the more expensive homes get. He's the housing shortage. We're short 7 million homes according to Habitat for Humanity. And he's zoning laws. There are 182 cities with rent control, and 81% of economists say it actually reduces affordable housing supply per the IGM Chicago Forum. The time tax collector doesn't rob you all at once. He takes it slowly, monthly, invisibly. Over 40 years, he took $126 million from you and gave you zero equity back. Okay, let's put actual numbers to this. I'm going to show you two people. Same income, same 40 years, different choice. The renter starts with $500,000 spent on housing over 40 years. That's about $1,250 a month average, adjusted for rent inflation. First deduction, the landlord's cut. minus $500,000 because you don't own the property equals zero. Wait, what? Yeah, every single dollar you paid, gone. It paid your landlord's mortgage, not yours. Your final net worth from housing, $0. Now the homeowner. Mike also has $500,000 spent on housing over 40 years. That's mortgage payments, taxes, insurance, maintenance, the real cost. First deduction, interest to the bank, minus $215,000 in interest on a 30-year mortgage at 7%. That leaves $285,000. Ouch. The bank took their cut. But wait, there's more. Second deduction, property taxes and insurance, minus $85,000, about $2,000 a year for 40 years. That leaves $200,000. Government and insurance got their piece. But wait, there's more. Third deduction, maintenance and repairs, minus $50,000 for new roof, HVAC, plumbing over 40 years. That leaves $150,000 remaining. So Mike spent $500,000, but $350,000 evaporated to banks, taxes, and repairs. Sounds bad, right? But wait, there's more. Plot twist, home appreciation. Mike's house cost $250,000 in 1985. FHFA data shows homes appreciate about 3.5 to 4% annually. 40 years later, that $250,000 house is now worth $900,000. Mike's final net worth is $900,000 in home value minus zero for the paid-off mortgage. That's $900,000 in equity. Mike spent $500,000. Mike now has an asset worth $900,000. Net gain, plus $400,000. Your final net worth as the renter? You spent $500,000. You have zero in equity. Net gain, negative $500,000. But wait, even more bad news. Mike's mortgage was fixed at $100 a month for 30 years. Years 1 through 30, Mike pays $100 a month. Years 31 through 40, Mike pays zero per month because the house is paid off. Your rent? Year 1, $1,000 a month. Year 10, $400 a month. Year 20, $1,900 a month. Year 30, $2,600 a month. Year 40, $3,400 a month. While Mike's payment disappeared after year 30, yours grew for all 40 years. At ages 65 to 85 during retirement, Mike's housing cost is $400 a month for just taxes and insurance. Your housing cost is $4,200 a month because rent keeps climbing. Mike lives on Social Security and a small pension. He's fine. You live on Social Security and a small pension. You're drowning. Okay, so you're watching this and thinking, I know buying is better, but I just can't afford it right now. That's the trap. And it's got a name, sticker shock syndrome. Here's how it works. You're 28, looking at apartments. Option A is rent, $1,800 a month. First month plus deposit equals $3,600 upfront. You think, that's totally doable, I have that. Option B is buy, $2,400 a month mortgage. Down payment is $50,000. Closing costs are $8,000. Total upfront, $58,000. You think? $58,000? Are you insane? Your brain sees rent as small, safe, comfortable. Buying looks huge, scary, impossible. So you rent. What your brain didn't calculate, 10 years later, the cheap rent started at $1,800 and is now $2,600. Your 10-year total is about $246,000 spent. What you own? Zero. The expensive mortgage stayed fixed at $2,400 forever. Your 10-year total is about $288,000 spent. What you own? $130,000 in equity. You spent $42,000 more on the mortgage, but you gained $130,000 in equity. Net, you're $88,000 richer. Meanwhile, the renter spent $246,000 and has nothing. But your brain at 28 didn't see that. All it saw was rent costing $3,600 to start versus buying. Costing $58,000 to start. That's sticker shock syndrome. The upfront price blinds you to the lifetime cost. It's like choosing a $50 a month gym membership for 10 years. That's $6,000 total, instead of buying $600 worth of dumbbells once. The $50 feels cheaper. The $600 feels expensive, but you end up spending 10 times more on the cheap option. The 3 lies your brain tells you. Lie number 1, I can't afford a house. Truth. You can't afford the down payment, but you can afford the monthly payment. You're already paying similar rent. Lie number 2. Renting is cheaper. Truth. 30 years of renting costs $126 million. 30 years of owning costs $1.3 million. Basically the same. Except renters end with zero. Owners end with a $900,000 house. Lie number 3. I'll buy when I'm ready. Truth. You're waiting for the perfect time. The perfect time was 10 years ago. While you waited, homes went up 50% and you paid $120,000 in rent. Sticker shock syndrome is why you're broke. Not because you're bad with money, because your brain chose the thing that felt cheap. All right, we've beaten you up enough. Let's fix this. You need a mental reframe. I call it the equity seed method. Old thinking goes like this. I'm saving money by renting until I can afford to buy. That $60,000 down payment is money I'm losing. What if I need it? So you keep $60,000 in savings, earning 0.5% interest while paying $2,000 a month rent. You feel safe. You feel liquid. But here's reality. Every month you're taking $2,000 and setting it on fire. Over 10 years, you pay $240,000 in rent and still have your $60,000, which inflation turned into $45,000 in purchasing power. You didn't preserve wealth. You destroyed it slowly while feeling safe. Now flip it with new thinking. That $60,000 down payment isn't money you're losing. It's a seed you're planting. Year 1, you plant $60,000. Your $300,000 house is worth $300,000. Your equity is $60,000. Year 5, that seed grew. Your house is worth $360,000 based on 4% annual appreciation per FHFA. You've paid down $25,000 of your mortgage. Your equity is $145,000. Your $60,000 seed became $145,000. Year 10, your house is worth $430,000. You've paid down $60,000 of your mortgage. Your equity is $190,000. Your seed became $190,000. Year 30, your house is worth $900,000. Your mortgage is paid off. Your equity is $900,000. Your $60,000 seed became a $900,000 tree. That's a 400% return. Name one savings account that does that. Stop thinking of your down payment as money leaving your pocket. Start thinking of it as money changing forms, from cash, which inflation kills, into equity, which compounds and grows. When you pay rent, that money is gone. Vanished. Dead. You'll never see it again. When you pay a mortgage, that money transforms into ownership. Every payment is part rent to the bank as interest and part buying your house from the bank. After 30 years, you own the whole thing. The equity seed method says, stop hoarding cash that's rotting in a savings account. Plant it. Let it grow. Yeah, it's scary to put $60,000 into something you can't immediately touch. But you know what's scarier? Paying $600,000 in rent over 30 years and ending up with zero. Your down payment isn't an expense. It's the most profitable investment you'll ever make. You're not losing money. You're planting a seed that grows into a house you own. The renters are collecting receipts. The homeowners are planting seeds. 40 years later, one group has a pile of paper. The other group has a $900,000 tree. Stop collecting receipts. Start planting seeds. Okay, you're convinced. Now what? Here are 5 specific steps you can take this week to get off the paycheck treadmill. Step 1. Run your rent burn number tonight. Open your bank statements for the last 12 months. Add up every rent payment. Write that number on paper. Stick it on your fridge. Why? You need to see the damage. $1,800 a month times 12 equals $2,600 per year. Over 5 years, that's $108,000. That's a down payment. Over 10 years, that's $216,000. That could have bought a house outright in many markets. Action. Text yourself your 2024 rent total. Look at it. Feel sick. Use that feeling. Step 2. Open a house fund tomorrow morning. Go to your bank. Open a separate savings account. Name it House Fund or Escape Plan. Set up automatic transfer of $500 or whatever you can swing on the first of every month. The math, $500 a month times 3 years equals $18,000. That's 3% down on a $600,000 house with FHA. $500 a month times 5 years equals $30,000. That's 10% down on a $300,000 starter home. Pro tip: every raise, bonus, or tax refund, 50% goes to house fund. No exceptions. Action: set a phone reminder for 9 a.m. tomorrow that says, Open House Fund. Step 3. Pull your credit score this week. Go to annualcreditreport.com. That's the only official free site. Pull your report from all 3 bureaus: Equifax, Experian, TransUnion. Check your score. Anything below 6 on 20 means you're paying higher rates. Anything above 7 on 40 means you're golden. Fix these immediately. Pay off any collections, even $50 ones. They kill your score. Dispute errors. 30% of reports have mistakes according to FTC data. Pay down credit cards. Below 30% utilization. Set all bills to autopay so you never miss a payment. Why? The difference between a 620 credit score and a 740 score on a $300,000 mortgage is $280 a month. That's a $100,000 penalty over 30 years for bad credit. Action: go to annualcreditreport.com tonight. Read it with a beer. Fix it tomorrow. Step 4. Research first-time buyer programs this weekend. Google your state plus first-time home buyer programs. Most states offer 3 to 3.5% down payment requirements, not 20%. That's a myth. They offer down payment assistance. Some give you $5,000 to $15,000 in free money. Lower interest rates for first-timers. Closing cost help. Programs to check. FHA loans require 3.5% down with credit scores as low as 580. VA loans require % down if you're military or veteran. USDA loans require % down for rural areas. And rural covers more places than you think. State housing finance agencies often offer $10,000 or more in free down payment assistance. Reality check: you won't think you need $60,000 to buy a $300,000 house. With FHA, you need $2,500. That's 3.5%. If your state offers $10,000 in assistance, you need $500. You're waiting to save $60,000 when you actually only need $500. Action: block 2 hours this Saturday. Title it, Research House Programs. Step 5. Run the real numbers before you give up. Go to a mortgage calculator like Bankrate or NerdWallet. Plug in the home price. Look at Zillow in your area for 3-bedroom starter homes. Plug in your down payment, 3.5% for FHA or 5% for conventional. Check current interest rates, around 6.5 to 7%. Add property tax. Google your city plus property tax rate. Estimate insurance at about $1,200 a year. Now compare. Rent monthly payment is $2,000. Buy monthly payment is $2,600. After 5 years, you've paid $120,000 in rent and own zero. After 5 years of buying, you've paid $156,000 and own $80,000 plus in equity. After 30 years of renting, you've paid $720,000 and own zero. After 30 years of buying, you've paid $936,000 and own a $650,000 house free and clear. Reality: buying is usually only $400 to $800 more per month than rent. And that extra $400, it's buying you a house. But your rent will go up to match the mortgage cost in 5 years anyway. So in year 5, you're paying the same amount. One owns a house. Action: spend 20 minutes running numbers. Write down rent versus mortgage over 30 years. See the difference. Look, I know this video probably made you angry. Maybe at me, maybe at yourself, maybe at the system. But here's what I need you to understand. This isn't about making you feel bad for renting. Renting isn't a moral failure. Sometimes it's the right move, when you're young, when you're figuring life out, when you need flexibility. But 40 years of renting? That's not a choice. That's a trap. And the longer you stay on the paycheck treadmill, the harder it gets to step off. The median first-time homebuyer is now 38 years old. Your parents bought at 28. That's 10 years of equity your generation lost. 10 years of home appreciation. 10 years of forced savings through mortgage payments. That 10-year gap? According to NAR data, it's worth about $150,000 in wealth that you'll never get back. Every year, you wait thinking you're not ready. Homes get more expensive and you fall further behind. I'm not saying buy a house tomorrow if you're not actually ready, but I am saying stop lying to yourself about why you're waiting. You're not waiting to be ready. You're waiting to feel comfortable with a number that will never feel comfortable. That $60,000 down payment? It's going to feel scary whether you're 28 or 38 or 48. The difference is, at 28, you have 40 years for that seed to grow into a tree. At 48, you have 20. Time is the one resource you can't get back. 40 years sounds like forever when you're 25, but your parents blinked, and now they're 65. And the ones who bought a house aren't worried about rent going up in retirement. This isn't about being rich. It's about being free when you're too old to keep running on someone else's treadmill. Look, if this video just made you rethink every rent check you've ever written, or if you're suddenly doing math on your phone calculator right now, trying to figure out how much you've actually spent, hit that like button. Because we just broke down 40 years of housing math in 20 minutes, and you deserve to understand what's really happening to your money. And if you're someone who's in your early 30s still renting and just realized you've paid your landlord enough money to buy a car, and you're starting to panic that you're running out of time, make sure to hit that subscribe button, because we're going to show you exactly what those years cost and what you can still do about it. Next week, we're breaking down the actual steps to save for a down payment when rent is eating 40% of your paycheck. Not theory, not just save more. Real strategies that worked for people who felt as stuck as you do right now. And if you've got a friend who keeps saying, maybe next year about buying a house, send them this video, not to pressure them, just so they can see the real math. Because nobody's teaching this stuff, and the paycheck treadmill doesn't stop just because you're not paying attention to it. I'll see you in the next one. Now go open that house fund account.